Commodity overview and catalyst breakdown. Crude oil futures have capped off their strongest monthly rally since March, with West Texas Intermediate settling near $84.67 per barrel, while Brent crude has reclaimed the key $90.12 threshold. The primary catalyst driving this multi-week price acceleration is a renewed wave of geopolitical risk premiums across key Middle Eastern shipping corridors alongside severe tightening in prompt physical availability. Commercial vessel transits remain on high alert near critical choke points like the Strait of Hormuz, forcing global refiners to actively bid up deliverable spot cargoes to secure short-term operational runs. This ongoing physical market dislocation provides immediate pricing power to upstream domestic energy extractors, setting up a high-margin cash flow environment for premier U.S. producers. Macro drivers and central bank forces. To map the macro environment for crude, we must monitor foreign exchange momentum and central bank rate expectations. Following the Federal Reserve's decision to hold benchmark interest rates in the 3.50% to 3.75% target range, the US dollar index, DXY, has consolidated near the 101 mark. When energy input costs surge, higher retail fuel prices feed directly into headline consumer price index prints, limiting the central bank's policy flexibility to aggressively ease interest rates. Furthermore, with strategic petroleum reserve levels sitting near historical low baselines around 307 million barrels, policy intervention options to artificially suppress future energy spikes via emergency crude releases remain severely constrained. Physical inventories and supply-demand dynamics. Turning to fundamental supply dynamics, the latest weekly status report from the U.S. Energy Information Administration confirms a massive commercial crude inventory drawdown of 7.2 million barrels, dropping total commercial stockpiles down to 404.5 million barrels, approximately 6% below the 5-year seasonal average. This severe stock draw comes as domestic U.S. refinery inputs operate at an elevated 17.3 million barrels per day, utilizing 97.2% of operable capacity, demonstrating robust physical demand for heavy distillates and transportation fuels. With OPEC Plus maintaining strict production quota discipline and U.S. shale operators in the Permian Basin prioritizing capital return programs over rapid rig deployment, the physical crude market is operating in a tight structural deficit. High-impact USA stock winners. For U.S. equity investors, crude oil trading comfortably above $80 per barrel generates substantial free cash flow yield expansion for large-cap integrated energy majors. The premier upstream leader in the U.S. market is ExxonMobil, NYSE, XOM, operating with low break-even extraction costs and massive global refining scale. Every $10 expansion in realized crude pricing adds billions in operational cash flow to fund share buybacks and dividend growth. Our second key energy winner is Chevron Corporation, NYSE, CVX. Chevron features a fortress balance sheet and premier Permian Basin asset positioning, allowing it to capture expanding gross margins during energy rallies without incurring high capital expenditure inflation. For broad sector exposure across upstream producers and equipment service providers, the Energy Select Sector SPDR Fund, NYSE, XLE, offers a liquid, high-yielding vehicle to capture ongoing energy sector momentum. Squeezed USA stock losers. While upstream energy extractors capture high operating margins, sustained crude rallies act as a direct input cost tax on energy-intensive downstream U.S. business sectors. Commercial airlines represent the primary wave of margin compression, as heating oil and jet fuel spot prices exceeding $4.13 per gallon directly erode operating margins when ticket pricing cannot immediately offset fuel costs. The second major sector facing earnings drag includes global freight, trucking, and supply chain logistics networks, with national average retail diesel fuel prices advancing above $5.31 per gallon. Fleet transportation costs compress net margins for carriers lacking automatic fuel surcharge pass-through mechanisms. Tracking these input cost pressures allows you to protect portfolio performance by avoiding margin-sensitive equities during sustained commodity price shocks. Forward look and technical roadmap. Looking at the technical chart roadmap for WTI crude futures, $81.50 per barrel acts as primary institutional support, with $83.50 providing an immediate technical floor. To the upside, a confirmed breakout above $85.80 opens the technical pathway toward the major resistance target band between $88 and $92 per barrel. Over the coming week, market participants will monitor upcoming weekly petroleum status reports, U.S. monthly inflation readings, and OPEC Plus production committee updates. Maintain a disciplined allocation approach by using short-term price pullbacks towards support as potential dollar-cost averaging opportunities in Tier 1 energy majors like ExxonMobil, XOM. To see how crude oil movements connect directly to our broader stock market coverage, click the video on screen right now to watch our full U.S. market breakdown. Make sure to subscribe to Global Macro Pulse, and we will see you in the next update.